Good morning, students. So we have yet again one more part of journal. Over here, I will be doing both golden rule as well as modern approach of debiting and crediting side by side, so that you will understand that more or less both are same. But in some places, some rule you may like, some rule you may feel it is easy, like golden rules you may feel easy, or you may feel in some places modern approach easy. So whatever you feel, that way you can just go on doing. The basic purpose is that your journal should come correct. Let's straight away start our exercise and understand this both the concepts together. Started business. First of all, accounts involved. Cash and capital. See, under golden rule, cash is a real account. And real account, what comes in? Debit. Whereas under modern approach, cash is an asset. An asset is increasing in the business. And as asset is increasing in the business, so we have what? As asset is increasing in the business, so we have debit. Whenever asset increases, we have debit. Next is the capital part. Capital is personal account. The owner has given the money, so give a credit under golden rule. And under modern approach, capital is a liability. Liability means something which the business is liable to pay. Now over here, the business is liable to pay to the owner. That is capital. And whenever liability, which has a credit balance, increases, we have to credit it. Purchased goods, purchase and cash. These two are the accounts involved. See, purchase is a nominal account. Nominal means expenses. So nominal account, expenses increasing in the business, so it will be debit. Expenses or losses will always be debited. Debit all loss and expenses as per the nominal account. And asset under modern approach, you can say purchase means goods is coming in the business. Asset is increasing in the business. Stock is increasing in the business. So asset increases, debit. Again, the second account involved was cash. Cash is the real account, and real account over here is going out. That means your cash is going out. So real account cash goes out. So what goes out is credit. What goes out is always credit under golden rule. Whereas cash is an asset. Cash is also an asset. Now when cash is an asset, asset is increasing in the business, or asset is decreasing in the business, then decreasing means it will be what? It will be debit. It will be credit. Asset decreases, so it will be credit. Next is purchase goods from J in cash. Almost same thing. Nominal account purchases under golden rule. That's why it will be debit. And asset under modern approach, asset is increasing in the business, goods is coming in the business, and that is why debit. Similarly, cash is reducing from the business. Cash is a real account. Cash is a real account. Real account, what goes out is credit. And similarly, asset is reducing. If you consider the modern approach regarding cash, cash is going away from when you purchase the goods. So when cash is going out, or cash is reducing from the business, it will be credit. Cash is decreasing, credit. Sold goods to Avi. In this case, cash, which is a real account, and real account, what comes in is debit. That's why cash is debit. And sales is a revenue. Nominal account, credit all gains and incomes. So it will be credit all gains and incomes. Credit all gains and incomes. So credit all gains and incomes. All gains and incomes are credited. That's why sales is a gain. Gain is credited. Whereas under modern approach, if you will think that when you sell goods in cash, cash is increasing. Cash is an asset. Asset increases. Asset has a debit balance, so it will be debited. Sales is a stock is going out, asset is decreasing, so credit. You can consider in modern approach also sales as a revenue, and that's why revenue increasing, further increasing, revenue has a credit balance, further increasing credit. Whatever way you take there, it will be always credit. Our purpose is that whether which is debit, which is credit, that we have to know. Paid J. J was our creditor. So our liability is reducing. That is why it will be debit. J creditor reduced. So liability reduced under modern approach. Liability has a credit balance. To reduce it, to decrease it, debit. And J is the receiver. If you think from the golden rule approach, J is the receiver of money. Any receiver is always debit. So personal account, debit the receiver. That's why it is debit. And next is we have paid cash to him. So our real account, what goes out is credit, and that is why cash is credit under golden rule. Whereas under a modern approach, cash is an asset, and asset is reducing from the business. And as asset is reducing from the business, so we are saying what? Asset reduce, so it will be credit. Next is received from Avi. When we receive money from Avi, cash, real under modern approach, cash and Avi, these two are accounts involved. First of all, there under golden rule, cash is a real account. Real account debit what comes in, debit what comes in. That's why this will be debited. Cash will be debited, and personal Avi is a personal account. Personal account will be credited, giver credited. So as giver, Avi is the giver of the money, so he will be credited under golden rule. So he will be credited. Under modern approach, cash being an asset, asset is increasing in the business, that's why debit. And Abhi who was my debtor from whom I was going to receive some money, he was my customer who has taken the goods on credit. He is paying now, so my debtor is reducing. So debtor being a debit balance, when reducing, it's credit. Similarly, we have paid wages. Now see this one. Wages is a nominal account. Any expenses loss, they are always debit. And under modern approach also, expenses are increasing. That's why debit. Over here, expenses and losses are always debit. Over here, expenses and losses are increasing. That's why debit. Cash being a real account, what goes out is credit. And asset is reducing under modern approach. That is why it is credit. Received rent under golden rules. Received rent, first of all, cash and rent, these two items are involved. Cash will be debited because real account debit what comes in, and rent is credited because nominal account credit all gains and incomes. Whereas under the modern approach, asset is increasing, cash is increasing means asset is increasing, so asset account is debited. And rent is an income. Rent is an income. So any income when increases, revenue increases. So income or revenue. So revenue whenever increases will be a credit because revenue has a credit balance. That's why revenue increases. That's why it will be credit. Now the next item is deposited cash into bank. First of all, items involved. Bank and cash. Bank and cash, two accounts are involved. Under golden rules, bank is a personal account. Debit the receiver. When you deposit the money, my bank balance is increasing. Money is going to the bank. Suppose I am giving money to Ram. So Ram is getting the money. Ram is the receiver. Simply, I am giving the money to Banka. Banka, the personal account is increasing. That means Banka is getting the money. Similarly, bank, suppose SBI, RBI, SBI, BOB, whatever, not RBI. So whatever bank is receiving the money, bank being a personal account, debit the receiver. And cash is going out, it's a real account, what goes out is credit. Under modern approach, bank is an asset, cash also is an asset. Bank balance is increasing, that's why debit, asset is debit. And when asset is reducing, so cash is reducing, so cash is credit, asset decrease, credit. One more item we left out, sold goods in cash. Cash and sales, these two items, these two accounts are involved. Cash is increasing in the business, asset increasing, that's why debit. Or real account, what comes in, cash is coming in, so debit. Sales is a nominal account. Any income and gains will be credited. Over here, sales is considered a revenue. and revenue whenever increases, credit because it has a credit balance. Next is drawings of stock. Now drawing of stock is what? Two accounts involved are drawings and stock. Now drawings, was owner is the person who is taking the stock, so owner is the receiver, owner account debit, but we don't write owner. As per accounting parlance, we say drawings account debit. Personal account, drawing is a personal account, debit the receiver, whereas stock, real account, and it is going out, that's why credit. Under modern approach, drawings is considered as capital. Capital reduce credit. The capital reduce debit, that's why drawings debit. We can write capital also instead of drawings. And stock is decreasing from the business, that's why credit. So capital reduced, that's why debit, and stock is reducing from the business, that's why credit. Stock being an asset, asset reducing debit, asset reducing credit. Bought furniture. So whenever you buy furniture, furniture is an asset. Asset is increasing, that's why debit. And cash is also an asset. Asset is decreasing now, that's why credit. Under golden rules, furniture is a real account. Debit what comes in, that's why furniture is debited. And cash is also a real account. Cash, what real account, what goes out is credit, so that's why cash is credit. Hope you all have understand. If you have understand, please do this as I have given the rules under modern approach and the golden rules, and please classify the accounts and just do it as we have done. Classify them into, classify the accounts and do the modern approach and golden rules, debit and credit rules. Thank you, students. And please see the video number 4, 5 for other understanding, for your proper understanding.